Moving forward from the last video, when the liabilities are deducted from the assets, the difference is known as equity. Therefore, equity is the residual interest of the owner in the assets of the entity after deducting all of its liabilities. In other words, in case all liabilities are paid out of the assets of the entity, whatever amount of assets remains is the equity. That's why we have the word residual here, meaning remaining or leftover. In most instances, you will encounter problems wherein the assets exceed the liabilities. But please bear in mind that it is not impossible to have total liabilities which are greater than the total assets, in which case there is negative equity. Equity is usually called capital. It is also known as net assets and even net worth. Please take note, the term assets is one thing, net assets is another thing. They are not the same. In accounting, when you see the word net, it means something has been deducted from something. The assets, when deducted by the liabilities, become net assets. Anyway, again, these four terms basically refer to the same thing. Assets minus liabilities equal equity, capital, net assets, or net worth. However, the term equity or capital is mostly used by businesses or for-profit entities. On the other hand, the term net assets is commonly for non-profit organizations like churches, public schools, and charitable institutions, while net worth is for individuals, such as government officials and public employees. You may have probably heard of SALN, Statement of Assets, Liabilities, and Net Worth, which is required by law to be filed by those working in the government. So SALN is the equivalent term of the Statement of Financial Position or balance sheet for individuals. Equity is specifically called owner's equity in a sole proprietorship business, partner's equity in a partnership, and shareholders' equity or stockholders' equity in a corporation. Please note the placing of the apostrophe. Here, it's before the S because there is only one owner in a sole proprietorship. While here, here, and here, the apostrophe is after the S because of the plurality of owners in partnership and corporation. In the previous video, I mentioned that the statement of financial position shows how rich or how wealthy an entity is. Specifically, which element in the statement of financial position should we look at in order to know how wealthy the entity is? The equity. In real life, people judge a person as to whether he is rich or poor based on his assets. They see his big house, nice cars and gadgets, learn about a second house in another place, and think that the person is rich. But they do not have any idea about his liabilities. If his total assets, let's say, amount to 30 million pesos, but his liabilities total 35 million, in which case he has a negative net worth, can you still say that he is really rich? What if the creditors ask him to pay his debts immediately? He will have to sell his assets to be able to pay those creditors. In case he is able to sell all his assets for 30 million or even 32 million and use the money to pay his creditors, he will end up with no more assets except probably for a few personal items, but still have remaining liabilities. In short, we have to look at not only the assets but also liabilities. Or meaning to say, we have to look at the equity, which is total assets minus total liabilities, in order to determine how materially rich he really is. Of course, the advantage of that person who has total assets of 30 million and total liabilities of 35 million over another who has, let's say, assets of only 500,000 with no liability is that he had the borrowing capacity. Lenders were willing to lend to him, which he can use to his advantage to earn well from those borrowed funds and consequently keep on increasing his assets while regularly paying off his liabilities. So the time will come when he can turn his negative equity into a positive and large amount. But my point is, we cannot really conclude about how wealthy an entity is by merely looking at the assets. We have to consider the liabilities also to know how much is the equity, which is more revealing than the assets as far as material wealth is concerned. Moving on, from the elements of the statement of financial position came the accounting equations. One equation is that the assets are equal to the liabilities plus equity. From this, we can form two more equations, right? If we want only the liabilities on the left side of the equation, what must be on the right side of the equal sign? Two ways to determine. The first one is to apply what you learned in algebra, the transposition. If we want these liabilities alone on one side, we must transpose this equity to the other side. When we do that, this positive sign of the equity will become negative, so that this side will have assets minus equity. Hence, liabilities are equal to assets minus equity. If you do not like algebra, you may use another way, and that is to assume small figures for this equation. Let's say assets amount to 10. The liabilities 4. And the equity, of course, 6. To solve for the liabilities totaling 4, it must be 10 minus 6. Right? Since 10 represents the assets, while 6 represents the equity, then the liabilities are equal to assets minus equity. How about if what we want is to compute for the equity? Again, you can use transposition. The liabilities will jump to the other side. Its positive sign, there is a positive sign here, although you do not see it. It's just shy. That's why it's hiding. But there is a positive sign here for the liabilities. That positive sign will become negative when the liabilities jump to the other side. So that assets minus liabilities equal equity. Or you can play around with these figures. If equity is 6, then to solve for 6, it must be 10 minus 4. 10 is the total assets, while 4 is the total liabilities. So that equity is equal to total assets minus total liabilities. I hope you see my point in making this elaborate explanation. You do not have to memorize all of these accounting equations. Knowing one is enough. You will be able to reconstruct or recall the other two when you know the first one. Please bear in mind a friendly reminder if you want to succeed in this subject. Accounting is not really a matter of memorization. You need to understand the lessons and apply logic. That way, accounting will be interesting and easier to learn. Of these three accounting equations, this one is considered as the basic accounting equation. Primarily because most entities, in preparing their statements of financial position or balance sheet, show the assets on the left side, while the liabilities and equity are shown on the right side, in which case it is known as the account form, or the assets are shown above with the liabilities and equity presented together below, in which case it is called the report form. I will give you a tip on how to easily distinguish between account form and report form. You have already learned about the classifying phase, or more popularly known as posting. You have also learned that posting is done in a book called the ledger. The simple form of a ledger is the T account. It is called T account because it looks like the letter T. The T account clearly separates the left side from the right side. Hence, the statement of financial position is said to be in account form when the assets are shown on the left side, while the liabilities and equity are shown on the right side. Knowing now what the account form statement of financial position is, you must be able to remember that the form which shows the assets on top of the liabilities and equity must be the only other form, which is the report form. Before we end this video, let's see if you can apply your knowledge about the accounting equations. If the liabilities total 50,000, while the equity 70,000, how much assets does the entity have? 120,000. Because assets equal liabilities plus equity. Next, if the liabilities amount to 105,000, while the assets total 150,000. How much is the equity? $45,000. That is 150,000 minus 105,000. So that using the basic accounting equation as our way of checking or verifying, assets of 150,000 are equal to the liabilities of 105,000 plus equity of 45,000. So it's just a matter of adding or subtracting, then checking if your answer is correct using the basic accounting equation. Of course, if you are already very familiar with the other two equations, you may use them whenever you deem fit. The third one now. How much is the amount of the total liabilities? $375,000. So that assets of 500,000 would equal the liabilities of 375,000 plus equity of 125,000. Last item now. How much is the equity? $25,000. So that 65,000 total assets would equal the total liabilities and equity.